Welcome to the Commonwealth Home Ownership Podcast, the real estate investing podcast for Canadians. Whether you're a seasoned investor or just getting started, you've come to the right place. If you're looking for a way to take control of your life through real estate investing, stay tuned and be sure to join us at cwho.ca, your hub for all things real estate investing in Canada.
Hey everyone, welcome to another episode of the Commonwealth Home Ownership Real Estate Podcast. For today's guest, we have Nick McCullum. Nick is a software developer and director of growth at Passiv. So Passiv is a portfolio management software that makes it easy to manage your own investment portfolio. Set a target portfolio, rebalance with one click, and get notified when your portfolio drifts using the tool available in passiv.com. As awesome as real estate is as an investment vehicle, we think it's important to diversify. So today we invited Nick to talk about ETFs, exchange traded funds, mutual funds, index funds, stocks, bonds, and just other places where you can put money when you're not investing in real estate. The show had a ton of great info, and I think you guys will be really happy about all the stuff we cover. And I know I learned a lot. So without further ado, Nick McCullum. Welcome to another episode of the Commonwealth Home Ownership Podcast. I'm Phil Wong. With me as always is Brad Price, and today we have Nick McCullum joining us from Passiv, which is a DIY portfolio management software for investors. So welcome to the show, Nick.
Thanks, Phil and Brad. Thanks for having me.
Yeah, great to have you on the show. So first of all, tell us a little bit about yourself. Like, how did you decide to launch Passiv or help with Passiv? I know you weren't one of the co-founders, but I know you were one of the first people that joined the company. So can you tell us a little bit more about the company and what it does?
Yeah, so I guess I'll talk a little bit about my history professionally and kind of how I joined Passiv, the story with how the company was founded, just to give you guys some context about what we do. So I've kind of always been interested in entrepreneurship and finance, I guess, like from an early age. I was kind of that kid who would buy 6 Cokes for $5 and then sell them each for $1. And then, I'd make $1 and that was awesome. Go door to door or whatever. I had lots of kind of silly businesses like that when I was a kid. When I went off to college, I started out in biology, having my sights set on medical school. But I only did a few months of that before I realized that studying plant biology and mammal physiology was like not to me the super most interesting thing in the world. So I went to my academic advisor and I said, what can I do, to change majors, but still allow me to graduate in 4 years because I don't have to spend any extra time here if I don't have to. So the short story is she recommended I go change into a math degree. And a lot of the good internships for math majors are in finance and accounting. So I ended up doing an internship at TD Mutual Funds where I had kind of an opportunity to work in an office where we managed lots of different investing strategies. So in one corner of the office, there was, someone managing fundamental equities. In another corner, there was someone doing a bond mutual fund. There was even things as exotic as like synthetics and derivatives. So I learned a lot about investing, and that kind of kindled my passion for finance and the stock market, which I've kind of been working in ever since. The story of Passiv, I think, is actually really important to know if you want to have a good understanding of what the product does and who it helps. So Passiv, like the initial prototype, was developed by one of our co-founders, Brendan Wood, to solve a real problem that he was having managing his family's finances. So Brendan was trying to manage his own retirement account. He was trying to manage his wife's retirement account. And he was also trying to manage a few education savings accounts for his kids, RESPs. So the problem that this introduced for him is that each one of those accounts that he was managing had he had a different asset allocation in mind for them. So for his retirement account, he was pretty young at the time, so he probably had a pretty aggressive asset allocation. But for his kids' education savings accounts, they only had an 18-year time horizon, and he probably wasn't willing to bear as much risk for his kids' education just because of that. So he had 4 accounts, 4 different target portfolios that he wanted those to be invested in. And keeping track of all this became very arduous. He had a big Excel spreadsheet where he would put in his holdings in each of the accounts along with his contributions. And this spreadsheet would tell him what he needed to buy or sell to stay as close as possible to his target portfolio. So this took a lot of time. He had to do a lot of manual data entry, calculate the trades, and then go back to his brokerage and enter in the trades one by one. So this was where the idea for Passiv came to his mind. The initial prototype of Passiv just read in Brendan's account holdings from his brokerage account and did kind of replace the manual data entry that he had to do, but he still had to go back to his brokerage and enter his trades one by one. So it was still fairly time intensive. Today's version of Passiv is a really seamless way to manage a passive portfolio like that. The way that it works is you create a passive account, you pair your passive account to your brokerage account, and once that's done, Passiv allows you to set a target portfolio and rebalance into that target portfolio with one click. After that, we do all of the monitoring so that whenever your portfolio drifts from your target portfolio, you get an email that prompts you to log in and rebalance with that one-click trade functionality again. So that's like the 50,000 foot overview of our history and kind of what we do now. I'm happy to dive into like any of the specifics if that's helpful.
Yeah, for sure. Thanks for sharing that, Nick. First of all, any questions, Brad? I think.
Yeah, I do have a couple, and one that, like, you kind of, the way you say it, Nick, it sounds like everybody should know what it means. But tell me about a portfolio that goes out of balance, and why is it important for somebody to be able to rebalance it? And I guess kind of furthermore, why is it important to be able to do that with one click? Like, why is that the benefit?
Yeah, so there's kind of a lot of different, I guess, avenues that we can dive down for this, and I'll try to tackle them one by one just to keep it simple and easy to understand. So I guess the first thing that you should, investors should try to, I guess, recognize is like what causes a portfolio to drift away from where it was originally. And that's just like basically changing prices. So if you imagine a really simple portfolio that just has like two things in it, let's just say two stocks, but you might be a big technology investor and your portfolio is 50% Apple and 50% Tesla because you think iPhones and Model 3s are both awesome or something. So it's 50-50. If Apple goes up in price and Tesla goes down in price, you might now be at 60-40. And it would be time for you to sell some of your Apple to buy some of your Tesla to stay back as close as possible to that 50-50 allocation. So that's kind of like the dynamics of what causes rebalancing to be necessary. In terms of why it's useful, there's lots of different reasons. I would say the first one is that rebalancing kind of causes you to implement like the fundamental investing concept of buy low and sell high. So if you have a 50-50 portfolio that goes to 60-40 and you want to rebalance, you will naturally be selling some of the stock that went up, so selling high, to buy some of the stock that went down to, so buy low. So at the same time, you're selling high and buying low, and that kind of helps your returns to stay, consistent over time. So that's another thing. And then I would say the third reason why rebalancing is important is that it allows you to stay within your like risk tolerance. So for many people, diversification is the main way that they try to reduce risk in their investment portfolio. Diversification just means like owning a small portion of your portfolio in many different investments so that if any of those investments does really poorly, it has a dampened effect on the overall performance of your portfolio. Basically the idea of don't put all of your eggs in one basket applied to investing. So what rebalancing does is if any of your holdings does really, really well and grows in size relative to the rest of your portfolio, you can kind of trim it down so it remains an appropriately diversified part of your overall portfolio. Does that make sense?
Yeah, absolutely. So if you're let's go back to the Tesla Apple example there. If you sell your Apple shares because they've gone up, but you're also then purchasing shares that have gone down, would that not mean that you're at net zero at that point in time for an increase in portfolio value?
Assuming that they went up, assuming that the poor performer went down by the same amount as the good performer went up, then yeah, you would be kind of still have the same overall portfolio size.
So that's the part I'm struggling with on a personal level is how do you create this portfolio that continues to increase over time by utilizing passive?
Yeah, so if you're investing in a really diversified portfolio, two stocks does not really make a truly diversified portfolio. That's extremely concentrated, and most people should own 20 to 30 stocks if they're doing individual stocks at the very least. And we actually recommend most people invest in, I guess, diversified index funds, which we can talk more about later. So those are just funds that own a whole bunch of different stocks, hundreds. So the way that rebalancing tends to be implemented in practice is not really with a two stock portfolio where they go up and down by the same amount, but more so with a really diversified portfolio. And because stocks and other marketable securities tend to rise in value over time on average, you might have 60 or 70% of your portfolio that went up in value and 30 or 40% that went down in value, so that when you rebalance, your overall portfolio is still growing, but you're selling some of your winners to buy some of your losers. You just tend to have more winners or winners with higher price increases than your losers in number or in magnitude, I suppose.
Okay. Yeah, no, that makes sense. And definitely I think it's probably a better example to use with a diversified fund rather than two stocks. That's a hard way to kind of create that increase when you're selling one to buy the other, essentially.
Mm-hmm. So let's move a little further into what you just said, Nick. Can you go over what the difference is between, say, an ETF, an index fund, and a regular stock that you can buy on the exchange?
Absolutely. So I guess we'll start with stocks because I think in many ways they're kind of the most simple unit of investment, like of a tradable investment. So a stock is just a part ownership of a business. So if you buy stock in Coca-Cola, it means you own a very small part of the Coca-Cola business. Similarly for Apple or Facebook or any other stock that trades on the stock exchange, when you buy that stock, you become one of the owners of the business. So what does that entitle you to? There's kind of three things that owning a stock gives you as one of the shareholders. The first thing is that you get to vote on certain company issues. So shareholders get to do things like vote on who gets elected to the board of directors and other kind of big corporate matters like that. Those fall under the realm of shareholder vote. In practice, individual shareholders usually, aren't rich enough to make a big difference in shareholder votes. Those shareholder votes are generally kind of controlled by people that operate at the institutional level with hundreds of millions or billions of dollars of assets under management. But we still get the opportunity to vote. And if you own shares in individual businesses, you'll probably get things in the mail that say like, hey, it's time for you to vote on who you want the new Facebook board of directors to be, or whatever stocks you have. So that's the first thing. The other two things are that you actually have kind of like a claim on a certain proportion of that company's earnings and assets. So if you own 1% of a business, then technically you own 1% of its earnings and 1% of its assets. So if that company ever liquidated, that money would be distributed to you. So that's kind of like the three things that owning a stock or just a fractional share of a business would give you. Now, index funds and ETFs are just like basically investment vehicles that pool money together to buy lots of different stocks. So we'll start with index funds, and then I'll talk about ETFs as kind of one example of how index funds can be structured. An index fund is an investment fund where a bunch of investors pool their money together to be professionally managed by an investment professional. And that fund is benchmarked to an index. An index is just a group of stocks that is kind of determined to be fairly representative of a certain asset class. And an index fund tries to replicate the holdings of that index as closely as possible. So I'll use an example because I think that can help people understand exactly how it works. In the United States, the most popular stock market index is the S&P 500. S&P just stands for Standards and Poor because that's the company that created this index in the first place. So the S&P 500 is the 500 largest companies in the United States, weighted by market capitalization. So it's the 500 biggest companies weighted in a way that the bigger companies have more weight in the index and the smaller companies have less weight in the index. So the biggest company in the world, I think, is probably Apple or some technology stock right now. That would be the biggest constituent of the S&P 500. And then the 500th largest company in the US would be the smallest constituent. The S&P 500 index fund would be an investment fund that tries to own what's in that index as closely as possible. So what that does for investors is it allows them to get exposure to a certain asset class very easily. So if you say, I want to bet on the economic future of large companies in the United States, owning an S&P 500 index fund is a great way to do that. Now, there's two main types of index funds. One is like a mutual fund and one is an exchange traded fund or an ETF. So these are basically two different structures that you can use to run an index fund. And they kind of both have different characteristics, but we're big fans of ETFs because of three reasons. So the first reason is that they're generally lower fees than mutual funds. All of these investment funds charge you a kind of a running fee every year for the duration that you're invested in the fund. And that fee for ETFs is just a lot lower than it is for mutual funds. So that's a win for investors. The other thing is that ETFs are more liquid than mutual funds. ETFs, you can trade them at any point as long as the stock market's open. So that's usually from around 9 to 5, depending on which stock exchange it is. Whereas mutual funds only trade once per day. So ETFs just give you a little bit better liquidity. And the third reason why we like ETFs better than mutual funds is because ETFs have better tax advantages. So if you're invested in a mutual fund, you pay tax on the performance of that mutual fund every year as long as you're an investor in the fund. Whereas with an ETF, you can actually defer those taxes. So if you own the ETF and it rises in value over time, you don't actually have to pay any tax on the ETF until the time that you decide to sell it. So those are kind of three reasons why we like ETFs as a structure for running an index fund versus mutual funds. And index funds are just investment vehicles that pool money together to buy a bunch of stocks. So those are the three things you talked about and kind of how they relate to each other, if that makes sense.
Yeah, totally. That's awesome. I guess that leads to the question then, what is the difference between, if index fund is similar to a mutual fund, then how is a index fund different than a mutual fund?
Yeah, so there are certain mutual funds that are index funds, and there are certain mutual funds that aren't. And this kind of is related to the concept of passive investing versus active investing. So the concept that we talked about with index investing, where there's a published stock market index and you want to get passive exposure to that through an index fund, that's called passive investing. And the reason it's called passive investing is because you're not trying to pick like the individual stocks that are going to do the best or anything like that. You're just picking an asset class and saying, I want passive exposure to it. And I just want to capture like the average performance within that asset class. So an example would be like for large cap stocks, it would be the S&P 500, like we talked about. Active investing is different. You're trying to make like individual picks on stocks based on the business's characteristics and competitive advantages, growth prospects, valuation, management teams, like all this kind of super research intensive fundamental investing type. Like you're basically trying to operate like Warren Buffett and pick the stocks that you think are going to do the best. So a mutual fund that operates in that way is not an index fund because it does not try to capture the results of an index. Instead, it's trying to beat the results of an index. Now, on paper, that could sound really attractive because everyone wants to make more money, right? But the problem with active investment management in aggregate is that active investment funds have to charge higher fees than passive investment funds because they need like a big research team to do all this due diligence, and there's like just a lot of extra costs associated with it. So on average, here's kind of how the performance of the active investment industry can be understood. On average, all of those funds will get average performance. That's kind of just like definitionally how it'll work. And that average performance is equal to the performance of the index that they're benchmarked to. So if you're trying to beat the S&P 500, on average, all of those funds will have the average performance of the S&P 500 minus their fees. And since their fees are higher than the passive investment fund fees, on average, active investment funds tend to do worse than passive investment funds. So to the extent that you can actually pick a winning investment manager, that's great. But the data and all of the academic literature suggests that it's really, really hard to pick a good active investment manager and that their performance doesn't really tend to persist over time. So you're kind of better off, statistically speaking, just picking a passive investment fund and sticking to it for the long term.
I read that more than 80% of actively managed funds do not beat the index over a 10-year period. Does that sound about right?
Yeah, I'm actually surprised it's that low. I've seen numbers. I mean, there's lots of different ways to measure this, and I think the methodology matters, but I've seen numbers in the 90% as well. And I think the probability of outperformance just goes down and down the longer your time horizon is. So I don't think there's pretty much any active investment fund out there that's beaten the index over like 50 years, for example. That's one end of the spectrum. On the other end, I think there's probably a lot more that have beaten it over 1 year because that introduces a lot more luck and those sorts of things.
I believe Warren Buffett actually made a bet with a fund company about almost a decade ago now that he said he would pay $1 million of his own money if any fund manager in that company can beat the index over a 10-year period.
Yeah, I know that story really well actually, because so the guy who made the bet with Warren Buffett, his name's Ted Seides, and he actually runs a popular investing podcast called Capital Allocators. Okay. But so the bet was struck in 2008, and basically Warren Buffett said, I'll bet $1 million that any active investment fund can't beat the performance of a passive S&P 500 index over the next 10 years. So this guy took him up on his bet, and Warren Buffett like published it in his letter and called him out by name and everything. And so the terms were $1 million to charity, like the loser donates $1 million to a charity of the winner's choice, I believe. And the fund that was picked to compete with the S&P 500 was actually a hedge fund of funds. So it was a fund that invested in different hedge funds, and those different hedge funds had really kind of exotic strategies that were supposed to be like sector neutral, market neutral, everything, like really complex, big brain investing strategies. And it tanked. So I think kind of the argument in hindsight that was made for this was that hedge fund was supposed to do well, like on average in a lot of different economic environments, but we had basically a 10-year extreme bull market from when this bet was struck to when it was over. So that's kind of the explanation for why it did so poorly. But yeah, I think that's a great example of what can happen if you make a lot of active investment fund bets versus just investing in the index.
Okay.
So Nick, just from a simplistic perspective, is it the human component that creates the expense? Is that really what we're saying here? And is that sort of something that you guys have been able to find a bit of a workaround for, and not having these massive teams in the background running around creating these extra costs?
Yeah, so I would say like if you're trying to make a new investment fund right now, just from like a marketing perspective, there's kind of two ways that you can market it. You can either say, we have some of the best investment researchers out there and we do really deeply, we read all the company annual reports and we know the management team by hand. We know what elementary school the CEO went to. Like, so that's kind of like angle number one, really good research. Angle number two is like some kind of quantitative investing strategy where you're like, oh, we have basically a bunch of Caltech PhDs doing machine learning on like the stock price to predict like whether it's going up or down. And we have the biggest computers in the world in our research office. So that's like angle number two. Now, both of those angles are super expensive, but like kind of for different reasons. So like on the one hand, the first scenario I talked about, you just have to pay like a bunch of CFAs, 6-figure salaries to do all this research. So that's expensive. And then on angle number two, you have to pay a bunch of PhDs, also high salaries. And then you have to pay for all this computer infrastructure too. So kind of the two, I would say, main ways that people try to market new funds these days are both expensive, but for different reasons. And then in terms of like how to avoid that, I would say just go passive index and like there's the problem solved like that.
Fair enough. So, like, you guys have this app Passive that you're working with now. How like you and I were sitting here, or Phil and myself were sitting here chatting with you in person. What sort of personal aspect is there to Passive? If somebody wants to get in contact with somebody or pick up the phone, because I feel like for me, when I'm all these apps available to put your money into and run with on the stock market, but what concerns me is the personal aspect, and I think it's really cool that we can sit here and have this conversation in person, and it really just shows that there is there is that personal aspect to your app. But like, how does that work for you guys?
Yeah, so Passive as like a platform and like a software tool, we take a lot of pride in providing like really excellent customer service. So there's a support page on our website. You file a help desk ticket, it goes directly to my colleague Alex. He kind of triages it, sends it to the right person to solve that problem. A lot of the time, I think he kind of ends up solving these himself. But I think if you were a user of Passive and you ran into any hiccups when getting started or anything like that, I would be very surprised if you weren't delighted with how quickly you responded and how well we kind of handle your support ticket. So from a just purely software point of view, there's that. From a investment advice and like getting started point of view, Passive is a tool that's designed for people who kind of know what they want to invest in and want a really customizable tool to help them on the way. So we actually don't provide investment portfolios or anything like that for you. You have to, I guess, to some extent, self-educate or feel confident enough to pick your own investments. And then once that's done, we're the tool that you should use to kind of manage it along the way. With that said, we're also big believers in the concept of empowering investors through education. So to the extent that we can make DIY investing accessible to people through a great software tool, that's awesome. And that's kind of what we spend a lot of our energy on. But we also think it's really important to empower investors through education. So we have a really big blog where you can learn lots of different investing and financial topics. We also have lots of tutorials on our website and that sort of thing. So the software tool is definitely what we spend a lot of our time on, but we recognize that sometimes for investing, getting started is the hardest part. So we're trying to do our best to help on the educational side too.
Yeah, that's great. And sorry, Phil, quickly, one more question. I'll jump in.
It's fine. No, go for
but
it,
is there some funds, there's like a minimum that you need to get started? Like how does that work with Passive?
Yeah, so with Passive, we kind of like, I would say the majority of our user base invests in ETFs or exchange traded funds. And with those, there's generally no minimum. So you can invest $10 in an ETF or what have you. ETFs trade as like units on the stock exchange, just like stocks do. So, if Apple stock's at $100, that's kind of a stock price. ETFs have a similar price for 1 unit of the fund. So basically the minimum investment for an ETF is the price of 1 unit.
Okay, that makes perfect sense. So that'll give everybody a good indication as to if they wanted to get involved and pick out a few or an ETF, kind of where they'd be looking to start. So.
Yeah, and I would say most ETFs, like their price is somewhere between like $0 and $100.
Mm-hmm.
And Nick, I just want to go back a little bit. I just want to do a little bit more differentiation between all the stuff that's out there. So we talked about stocks, index fund, ETFs. What's a hedge fund? Can you explain that?
Yeah, so a hedge fund, it's funny because a hedge fund can mean a lot of different things these days. I think the name was originally designed to imply that the fund was a hedge against unexpected market risks. So you might have like back in the old days when hedge fund actually meant hedge fund, I think you might have had, some hedge funds that were designed to hedge against inflation risk or some hedge funds that were designed to hedge against, I don't know, just like serious market declines. Other hedge funds might be designed to hedge against plunging commodity prices, things like that. Hedge funds today are basically sophisticated investment vehicles for accredited investors, which is basically investors who meet certain minimum net worth requirements. Basically investment funds for rich people. And yeah, basically the whole idea with a hedge fund is that they have a very specific mandate that's very differentiated from what, you know, most funds do. And they want complete autonomy over their ability to execute that strategy, and kind of in exchange for that differentiated market exposure, they charge high fees as well. So I think this fee structure has kind of come down over time, but the historical average hedge fund fee schedule was 2 and 20. So what that means is they charge you 2% of your assets under management every year, and then they also take 20% of your upside from the fund. So I think in terms of hedge funds in general, just because the fee schedules are so expensive, you're probably a lot better off if you're trying to get rich to actually start a hedge fund rather than investing in one. But that's just my opinion as a really fee conscious investor, I guess.
So, I mean, if fees are such a huge impact, especially when we talk about index funds, mutual funds, why do people invest in hedge funds at all?
I think there's, to be honest with you, a little bit of prestige in saying, oh, I'm invested in, you know, David Einhorn's Greenlight Capital Fund. Because a lot of these hedge funds are so like capacity constrained. That just means that their strategies really only work when there's only small amounts of money invested in it. So that's kind of the idea of capacity in terms of investing. So a lot of these strategies are capacity constrained. So if you're a rich guy, you actually probably have not too much utility in making an incremental dollar. But if you can tell your other rich friends that you're invested in a really prestigious investment fund, that'll probably bring you more joy than actually making money from the fund itself. So I think there's an element of prestige to it. But that's kind of that's my opinion as someone who's not rich enough to actually invest in these things. So you might be asking the wrong guy. I don't know.
So Nick, I've got a question for you related to accredited investors. Now, this is something that is important to us in the real estate investment industry, you know, working with joint venture partners and whatnot. But for listeners, can you explain exactly what an accredited investor is? What does that mean?
Yeah, the idea of an accredited investor was a concept put into place by the regulatory authorities to make sure that investors who were implementing sophisticated investing strategies were, I guess, wise enough to know the risks that they're undertaking. So I'm more familiar with the accredited investor rules in the United States just because of kind of virtue of my professional background. But in the US, I know that to be an accredited investor, you have to either prove that you have $1 million in liquid net assets, or you have to have annual income above $250,000. So the idea with that is if you have enough financial sophistication to either have $1 million or $250,000 of net income, then you should be able to self-educate yourself about the things that you're investing in, so that you can't kind of, I guess, complain or be litigious whenever those investment funds might not pan out. So basically the idea is they want to make sure investors are protected from undue risk when investing in exotic investment strategies. And this is, I guess, the regulatory measures that they put into place to do so.
Mm-hmm. And I'm just going to give a little bit of update. It's very similar in Canada, actually. But so the numbers are actually a bit higher in Canada. So as an accredited investor, you have to, either yourself or a spouse have to have net assets of more than $5 million and before tax income of $200,000 for an individual or $300,000 for a spouse for the last 2 years.
Do you have to satisfy both of those, or one or the other?
One or the other.
Okay.
Yeah, that looks like.
But yeah, just back to your point, Nick, like you said, it's really about ensuring that the people investing are of sound mind to do so, or sound understanding what they're investing or getting involved with. But it's also from the people offering the investment, is to ensure that they're in a way not taking advantage of people as well, you know.
Yeah.
Somebody proposing some sort of investment whereby somebody's about to invest everything they own, like they've got nothing left after this, you know, and they're maybe not familiar with investing, like you said. So you're kind of covering two bases there, you know, trying to do the right thing. So I think just to give a bit more info, I guess a lot of these kind of sophisticated investment vehicles that require accredited investors exclusively, they have characteristics that make them hard for normal people to invest in, like minimum buy-ins, for example. So if you have an investment fund that requires $50,000, that's probably
important for you to know that you're not taking someone's entire retirement into your hands to invest in your fund. A lot of them also have illiquidity characteristics. So one great example of that would be real estate. If you're taking people's money to invest in real estate, they can't just get that back next year because they would have, they'd have to transact the whole property, and usually they're only a partner in the property with some other investors. So that illiquidity means that it's important for people to have other assets that they could kind of draw down and rely on if they needed to.
Yeah, absolutely. Yeah, 100%.
Yeah, I know for real estate investing, depending on the amount of you need invested, yeah, the person out there has to be someone you know well, or a friend or family to bypass that accredited investor requirement a lot of times.
Yeah, I'm familiar with this kind of on a personal level, but I think there's two ways around it. You can be either a quote unquote personal friend, or you can be a quote unquote close business associate. Those are kind of the two ways that you can apply for exemptions around the accredited investor rules in Canada, to my understanding.
Otherwise, correct me if I'm wrong, but you need to then, if they're not an accredited investor and you're trying to get them to apply, you have to submit an offer memorandum, correct, to the SEC?
Yeah, I think so. Yes, I would say to anyone listening to this, I'm not a lawyer, and I'm probably like, I guess what I'm saying is do your own due diligence, but that does sound right to me.
Mm-hmm.
Yeah,
Yes.
absolutely. I mean, get familiar with the rules. I mean, they do tend to change over time as well.
Yeah. So for those looking for money to invest in their real estate projects, do your due diligence and ensure that whoever you're asking for the money is eligible to give that money, is, I guess, our advice. Otherwise, you might run into some trouble with the SEC. As real estate investors, I think it's important to diversify and not just have everything in one basket in real estate, as awesome as the investment vehicle is. So that's why we have you on the show and want to explain a little bit more about the stock market and exchange traded funds and passive investing. I'm a huge fan of the Canadian couch potato portfolio. And can you go over a little bit about that? Are you familiar with that concept?
Yeah, super familiar with it. So the Canadian Couch Potato website is a website designed at helping passive investors get knowledge and understanding about how to do passive DIY investing for the long run. I think what they're best known for is their model portfolio. So they have these different model portfolios. I don't know the exact names of some of them, and I think they may have went through a name change lately, but one example might be something like the Canadian Couch Potato Aggressive Portfolio. So you could go to the page for that model portfolio. It would show you what the model portfolio contains, and then it would kind of give you a description of maybe like what type of investor this model portfolio would be suitable for. If it's an aggressive portfolio, they might say something like, oh, this is for people in their 20s who are just starting their careers and have a long time horizon and robust risk appetite and all these other things. So I think the Canadian Couch Potato website's got lots of really good information about how to do DIY investing for the long run, with a special emphasis on providing model portfolios for people who want to manage their own investments.
Okay. And I mean, in terms of allocation, I know that there's it's important to spread yourself out among stocks, equities, and bonds. What is the importance of bonds, and what are bonds, first of all, and
why?
So
we talk. Yeah, I'll let you finish your question.
Sorry, yeah.
I do love bonds, so we'll.
Yeah. So what are bonds, and why is it important to have in a portfolio?
Yeah, so I'll just say sorry for interrupting you there, Phil. But
no, it's all good.
We talked about stocks being fractional ownership of a business. Bonds are kind of related, where instead of being fractional ownership of a business, you're basically being a fractional lender to that business. So if you're running a company, like let's say, hypothetically speaking, I'm the CEO of the Coca-Cola company, and I need to raise money to go build more Coca-Cola factories, I guess. There's two ways you can do that. You can either sell stock or you can sell bonds. Selling stock would be giving up some of your ownership of the business, and it hurts your existing shareholders because their ownership percentage gets diluted. So if you have all your shareholders, then you issue 50% more stock to fundraise for this new factory you're building. Everyone's percent ownership of the business goes down by 50%. You have all these crappy shareholders, and that kind of sucks. So that's like option A. Option B would be to issue bonds. Now, bonds are just a type of debt, just like mortgages, just like lines of credit or anything like that. So when you issue bonds, people own the bond, and you pay those bondholders every 6 months a coupon payment, which is just an interest payment. It has a different name because it's bonds, and finance likes to have all these different names to confuse people. But you pay them a coupon every 6 months, which is just your interest payment. And then when the bond matures, on that last payment, you pay them the coupon payment and the face value of the bond, which is just what they invested when they actually bought the bond. So to provide like an example, if I'm the Coca-Cola company, I want this factory. If I issued a a 2-year bond with a coupon of 10%, and investors wanted to buy it. Bonds usually trade in denominations of $1,000. So let's say, Phil, you want to buy my bonds because you like Coke and you think 10% bonds sound pretty good with interest rates at 1% or whatever. Just to be clear, that's highly unrealistic. I just wanted the math to be easy because I'm trying to do this on the spot. But so you buy this $1,000 bond, 2-year 10% bond. Every 6 months you would get paid $50 because that's half of your 10% interest payment, and you get it twice a year, so it makes 10%. So for the next 2 years, every 6 months, you get $50. And then on the last payment, you would get $1,050 because you would get the $50 coupon payment plus the $1,000 face value of the bond that you had originally purchased. So that's kind of like probably an over detailed explanation of what bonds are like. Now, the reasons why investors might want to own bonds is because they're a lot less risky than owning equities are. They're less volatile. So just in terms of like a practical ownership perspective, they go up and down in price a lot less than stocks do. And then in terms of actual like really pessimistic risk assessment, if a company is like really struggling and they have to liquidate their company and sell all their assets and send all the money back to all their different stakeholders, bondholders get paid before equity holders do. It's kind of like how if you had a house and you went bankrupt, the bank gets paid back on the mortgage before you actually get to take your down payment back, Mm-hmm. So bondholders are more senior on the capital stack. They're a lot less risky. And in terms of model portfolios, like the Canadian couch potato model portfolio that we had talked about, one of the main levers that you can kind of pull to reduce your risk over time is increasing the amount of bonds that are in your investment portfolio. So if we saw like, for example, the Canadian couch potato aggressive portfolio, it might be like 80% stocks and 20% bonds. Whereas if there was a Canadian couch potato conservative portfolio, it might be 80% bonds and 20% stocks because they want to increase that proportion of bonds in your portfolio as you get older, closer to retirement, and less risk tolerant overall.
Mm-hmm. And from what I understand, bonds offset stocks in the sense that when stocks go down, bonds typically increase. Is that right?
Well, I don't know. That's kind of what you're always taught in finance school, but I would say interest rates tend to really govern everything. So when interest rates go down, everything goes up, stocks and bonds. Bonds are a lot more, like the reaction that bonds will have to changing interest rates is a lot more measurable than it is for stocks, because bonds literally trade like step by step with interest rates. So if interest rates go down this percent, you can literally calculate what the price of your bond would go to, because every bond tends to trade with a yield to maturity pretty close to the current interest rate. There's lots of kind of math, and I could kind of talk about that for an hour by itself, and it's probably not super interesting to your audience. But I would say bonds trade step by step with interest rates. Stocks, the correlation is kind of lower, but it is directionally still positive or negative, I guess. So when interest rates go down, stocks go up. Now, I still think they provide lots of good diversification benefits, because even though they are influenced by the same factors, they don't always trade step by step. So they're not exactly negatively correlated, but they're not highly correlated either.
Okay. Because I was just thinking on the terms of investor psychology, because typically bonds, I mean, not just corporate bonds, but I think in the Canadian couch potato portfolio, they have Canadian bonds, right, which is like government debt. So in which case it's a safe investment, safe haven for a lot of investors, because government is unlikely to go insolvent. So then a lot of times when equities go down, what we're taught anyway, is a lot of investors then flock to government bonds because it's a safe haven for their money, because it's unlikely to go bankrupt in a poor market.
Yeah, I mean, in terms of government bonds, I guess I hadn't thought about that subset of bonds specifically, but I guess if you're thinking about investing in bonds, you should know there's kind of three main types of bonds. So I talked kind of about corporate bonds in terms of the Coca-Cola example. So that's like the riskiest type of bonds, because you're betting on the future financial stability of an individual corporation. And then one level up the safety ladder would be like provincial bonds. So if you want to buy Ontario government bonds, that's safer, because instead of having to bet on a company, you're kind of betting on a provincial government. And then the safest, the highest level would be like federal bonds. So Canadian savings bonds, those sorts of things, or US saving bonds in the States. And if you're listening to this from the States, the ladder would kind of be corporate bonds, state bonds, and then federal bonds. You guys don't have provinces, you have states instead. But so that's kind of like the hierarchy. And then in terms of the flight to safety characteristics that you talked about, that definitely is like pervasive, I would say. Yeah.
Okay. So, and I mean, this is something I've struggled with myself in terms of asset allocation with regards to what looks like an aggressive portfolio versus a conservative portfolio, because there's all these rules of thumb out there in terms of how much bond allocation you should have versus your your stock allocation, right? And a lot of people say, as you know, one of the rules of thumb is you should have the same bond allocation as your age.
Yeah,
I'm not a huge fan of that personally, but I'm just curious about your take on it.
Yeah, I mean, it's a very personalized decision, and there is kind of no real exact right answer, which I think why it's debated so much, and it's such an interesting, like, psychological concept. The rule of thumb that you talked about kind of does make a lot of sense, I think, but I would say, just broadly speaking, it's the most important thing is to develop an investment strategy that you are comfortable enough to stick with, even when things are going sour. So you don't want to own an investment portfolio that you're going to doubt when the market tanks like it did in 2008, or more recently like it did when the coronavirus pandemic first started, because usually when markets are going down, that's kind of like the last time that you want to deviate from your long-term plan. So like I said, there's no perfect right answer for this, but the most important thing is the ability to stick to it.
Okay. Yeah. In terms of, I guess, to educate people more, what resources would you recommend people can look into to learn more about investing in stock market, ETFs, et cetera?
Yeah, so I would say the first thing, and something that I think really would help people if they are thinking about get started, is to just get started. So I'm not saying go try to put all your money into crazy, sophisticated, risky investment strategies, but there is something about having real money in the market that really makes you pay a lot more attention to it. So if you want to think that you kind of want to start DIY investing and taking your portfolio management into your own hands from your financial advisor, or maybe you've never invested at all before and you just want to get started, I would say open up an account somewhere and just slowly start contributing to it over time, because once you actually start doing it, there's something about having real skin in the game that will make you pay more attention and learn faster. So that's kind of the first thing that I always recommend to people. The second thing, I would say, if you're in Canada and you want advice on model portfolios, the Canadian Couch Potato website I know is super popular, really useful for a lot of people. If you're in the US or international and you want kind of a similar resource, we're big fans of the Bogleheads website, which is kind of named after Jack Bogle. He was the founder of the Vanguard Group, which is a pioneer in the low-cost passive investing space. So the Bogleheads website is great. And then for me, like, just in terms of how to get more information into my monkey brain over time, like, I'm a pretty slow reader, so I really benefit, broadly speaking, from podcasts. It's really nice to be able to go out and walk my dog, and if I'm kind of in a learning mood, I can just put my headphones in and try to digest some information from like the podcast space. So there's a couple really good podcasts out there in the financial space. I'm a big fan of Patrick O'Shaughnessy's Invest Like the Best, and Ted Seide's Capital Allocators, Ritholtz Wealth Management's Animal Spirits. If you can kind of I try to get those 3 podcasts in every week, and I probably learn like more cumulatively from those 3 shows than like from all my college put together. So there's lots of great resources out there. If you can get on a cadence of digesting stuff every week, it really compounds your knowledge over time.
Okay, awesome. Sorry, just to go back a little bit, I just have what you said there just brought back a little question for me. In terms of investing into a fund on a regular basis, is it more, I mean, I know a lot of people around tax time, especially around now, RSP season is coming up or coming to an end at the end of February. And a lot of people tend to take a chunk of money and dump it into RSPs or TFSAs, or whatever it is, typical RSPs, and then have that money just goes towards their investments. So what is your opinion of doing it all at once versus a little bit over time?
Yeah, so I guess the most important thing, and this kind of echoes what I said earlier, but about a different topic. The most important thing is to do whatever you're comfortable with. But with that said, I think if you want to just take like an empirical, data-driven approach to this, there's a really great article from a guy named Nick McCullum, who is the chief operating officer at Ritholtz Wealth Management. He's a super smart guy. He runs a website called Of Dollars and Data, and he's also a computer programmer. So he posts these really interesting like articles that are kind of operate at the intersection of personal finance and data science. So he uses basically data to approach common personal finance arguments. So he has a really, really good article on dollar cost averaging. So dollar cost averaging is the idea that you invest the same amount of money periodically into the market. So an example might just be like you invest $200 biweekly every 2 weeks, and that's kind of your approach. So that's dollar cost averaging. And he has a really great comparison of dollar cost averaging versus lump sum investing. So just putting it all in right from the get-go. And I think the big conclusion is that lump sum investing pretty much always wins. And that's kind of the approach that, statistically speaking, you should take. But I understand that if you lump sum invest and the markets go down 20%, you can kind of panic sell. That can freak you out and you might sell out and then the market goes up, and that's a really bad outcome. So lump sum investing, I think statistically is probably has historically been the better choice, but not to the point where it might scare you into making bad investing decisions. So I guess what I'm trying to say is the evidence says lump sum investing, but psychologically speaking, I can definitely see the benefits of dollar cost averaging over time.
And dollar cost averaging, correct me if I'm wrong, but basically you just invest over time. So then you, as you keep buying, sometimes you buy it high, sometimes you buy it low, but over time it just kind of averages out to be like a more in between price, right?
Yeah, and I think the psychological benefit of dollar cost averaging is that no matter what happens, you're kind of winning either way. So if the markets go up, the stuff you already have rises in price, and you're like, oh, this is awesome. But if the market goes down, you're like, oh, I'm still buying. This is awesome. Like I get cheaper prices. So no matter what happens, you're not going to really have too much negative emotions that might like impair your decision making.
And also like it just moves you away from trying to time the market as well, which typically never goes that well for most investors.
Yeah. Well, I think that's kind of one of the problems with lump sum investing too. Is like if you let's say you liquidate your pension or something, you get this big stack of cash that you need to put into the market yourself. If that was me, I'd probably be tempted to wait, be like, oh, I'm going to time this perfectly. The next time the markets go down, I'm going to sock this right into stocks. And I don't know, if you did that like in 2008, right at the bottom of the market, you thought it was going to go lower, then your next opportunity was probably like 2020, and you would have missed out on like what 200% gains or something. So it can be really tempting to wait and try to time the market, which is, I guess, a peril of lump sum investing.
And I mean, one quote, I can't remember, I don't know who said it, but it's very similar in real estate as well, but it's not so much timing the market as time in the market. Correct.
Yeah. Charlie Munger's got a great quote too, where he says, the real money's not in the buying or the selling, but in the waiting. And in that sense, he was waiting after you buy, not waiting to buy. Like,
Yeah. I think you have to establish, like you said earlier, you have to establish your plan, your long-term plan, and really stick with it. You can't be making emotional decisions along the way because you wake up and check your portfolio one morning and it has dropped 20%.
Yeah, I mean, we talk a lot about how technology's like changed the investment management industry, and in many ways, it's like never been easier to be a DIY investor. But we also have like some negatives that come with that too. All of a sudden, we have access to like instant data on anything we want. We get the news headlines like directly to our cell phone, and then we also have brokerage apps on our phone where we can buy and sell whenever we want. So, do you think that results in better decisions or worse decisions? I think it probably results in worse decisions because all of a sudden you can impulse sell whenever something scary comes up. So yeah, it's never been a better time to be a DIY investor, but it's also never been easier to be a bad DIY investor, which is kind of the unfortunate truth.
Yeah, I think a lot of things, being an investor, I think a lot of things you have to work on. One main thing you have to work on is your psychological risk tolerance, right?
Yeah.
I think that goes with all markets, real estate or stocks.
And not everybody has a lump sum just to drop into a fund or an account. So I think having the ability to just pop in a couple $100 every week, it's affordable. It's a really affordable way to invest, So go ahead, Nick, you're about to say something.
Yeah, well, I know your audience is kind of like big in the real estate space. And I think what a lot of people kind of can benefit from in this sense is like, if you have all these rental properties, you're cash flowing like crazy and you're not quite like big enough where you're buying a property every month or whatever. You can kind of create a dollar cost averaging strategy that will allow you to invest that spare money until the point where you do have enough for your next down payment. If real estate kind of is your primary focus, and if it is your primary focus, I think there's still an argument to be made. You should diversify some of that away and have some in stocks or bonds or whatever. You never know when a big sudden expense might come up, and it's a heck of a lot easier to sell stocks than it is properties. I can tell you that.
I mean, it's a good point because I mean, as real estate investors, when we have cash flow, we have one of three choices, right? We can either A, reinvest it back into the mortgage, into the property, B, take it as cash, as income, or C, reinvest into something else. And based on current interest rates with houses, if you reinvest it back in the property, you're really only making 1 or 2% return. Take it as cash, it's zero because you're probably spending it, and then and then the alternative is to invest it into something like an index fund or ETF. So I mean that's definitely something that a lot of investors should consider.
Yeah, or whole life universal life policies that you can access later on. So there are lots of different options to utilize your cash flow, but to generate another return on your investment earnings, because initially they are an investment as well, right? You're making an earning with cash flow, so that's a return on your initial investment, and then you're putting it into something that's generating, an extra return, really.
Yeah, kind of diversifying your income streams over time. There's a lot of peace of mind that comes from that.
I guess based on that, then, what do you know what the statistical average return of the indexes or ETFs have been over the last decades?
Yeah, so it totally depends on, I guess, what you're trying to achieve and like what asset classes you're owning. If you want to just talk about like large cap American stocks, which I think is probably like one of the biggest, most popular asset classes, I think the historical long run return for the S&P 500 over long periods of time is something like 8 to 10%, depending on like how you measure it and what your time frame exactly is. But somewhere in that high single digit range is like the long run average for stocks.
Okay. Yeah, which gives which is important to give a bit of a reference point for where to allocate that money, right? In terms of between your mortgage or index funds or ETFs. Awesome.
So, sorry, I just have a quick question, Nick. With you said earlier in the podcast that you connect Passiv to your trading account. I just really want to understand. So basically, you can then continue to move money into your trading account. Do you then utilize those funds, place them, or purchase different ETFs, and your account is automatically, or Passiv is automatically balancing those that you're then purchasing? How does that integration work?
Yeah. So do you mean like how does what are the mechanics of how we rebalance, or what are the mechanics of like how we connect to your broker? I just want to make sure I answer the right question.
Yeah, the mechanics of both of those things you just said, but the actual purchasing and acquisition of those stocks, bonds, ETFs initially, is that done by the human component, like the actual user, and then Passiv is automatically like, how does that integration and work with the purchasing and then the rebalancing?
Yeah, so I'll touch, I guess, first on the integration, because that's like what has to happen first, I suppose. We're like, security is a core focus of our business model, right? We're a software company. We don't want anything bad happening from a security point of view. So we actually set up our integrations with brokerages using a protocol called OAuth, which is the exact details of it are probably kind of outside the scope of this conversation, because I know that not everyone's like a software nerd like me. But basically, the important details of OAuth are that we connect directly to the brokerage's infrastructure, and it's one of the preferred, most safest ways to do so. The big benefit of it is that we don't actually have to store any of your information like in our database or on our servers. The way that it works is when you connect to your brokerage, you get redirected to the brokerage's website. You authorize us, like a pop-up will come up saying, do you want to authorize Passiv to read your account holdings, make trades, and get some market data? You click accept, and then you get redirected back to our website with the token that kind of tells us that your brokerage authorized us to do all these things. So the benefits of that are that you can actually go into your brokerage account and at any time revoke your access to us, and then kind of our integration would stop working. But if you had, if you weren't happy with Passiv and wanted to make sure that that integration was done, you don't actually have to do it with us. You can do it with your brokerage. So all of the control remains with the third party, which is important. And then in terms of how the rebalancing works, when you set up for the first time and set your target portfolio within Passiv, that'll be kind of like your first big rebalance, I guess. And the way that a rebalancing always works is that you get a pop-up that shows you all of the trades that we recommend you make, and you have to confirm them before they get executed. So the final one-click trade, I guess, responsibility is always in the hands of the user. We'll never trade your account automatically or anything like that. You have to always click one, like, yes, I want to trade these, and you always get a preview first. So that's that. In terms of how new cash is handled, whenever new cash hits your Passiv account, if it's enough to kind of trigger a trade, like if enough cash has hit your account that you can actually buy stuff with it, you get an email that says, hey, new cash has hit your account. Click here to log in and we'll get you invested in your underweight assets with that new money. So that's kind of how the rebalancing calculations are handled from an initial point of view, and then also every time new cash hits your brokerage account.
Okay, great.
In terms of Passiv, in general, how much would a portfolio deviate before you consider rebalancing?
Yeah, this is a great point, because I think it kind of illustrates how we want Passiv to be a completely customizable solution that allows you to really tune how you want your portfolio to be managed. So this setting is completely configurable. We rely on a metric called portfolio accuracy, which is a measure of how close your actual investment portfolio is to your target investment portfolio. So if you're completely invested in your target portfolio, your portfolio accuracy will be 100%. If you don't own any of your target portfolio, it will be 0%. And then there's a spectrum from 0 to 100 based on how close you are kind of in between. So that portfolio accuracy metric is constantly compared to a related metric in the Passiv dashboard called drift threshold. Now, Drift threshold is basically a number that you specify that tells Passiv, I want to be notified via email whenever my portfolio accuracy falls below this number. So I'll put some numbers behind it just to help you understand a little better. If your portfolio accuracy was 95% and your drift threshold was 90%, then you would get no email. But as soon as your portfolio accuracy falls below 90%, which was your drift threshold, then we'll send you an email that says, hey, your portfolio has drifted. Click here to log in and rebalance with one click. And we'll do all of the trades to get you as close as possible to 100%. Now, depending on how frequently you want to be contacted by Passiv and how hands-on you want to be with your portfolio management, you might set your portfolio accuracy as high as 99% or as low as 50% or kind of anywhere in between based on what you're trying to achieve.
Okay. Is there a recommended drift deviation that before you rebalance?
Yeah, we don't really we try to the extent possible to let our users use Passiv however they want. So we don't have like a recommended number, but it is defaulted when you first create your account to 90%, I believe.
Okay. And I mean, and on the outside of Passiv institutionally, have you read anything that any recommendations when you should rebalance based on how much your portfolio drifts?
There's a investment research and asset management firm I think they're based in Los Angeles, named Newfound Research. Their CIO is named Corey Hofstein, and he publishes excellent investment research on the concept of rebalance timing luck. So that's the whole idea that most institutional investment funds or mutual funds or ETFs, they have some sort of rebalancing schedule, quarterly, monthly, depending on kind of what the fund is. It can be a number of different frequencies, but his whole idea behind that research is that the periodicity of these rebalances has a huge unpublished impact on their investment returns, because if you rebalance at the low point of the market, you're going to be a lot better off than if you rebalance at the high point of the market and that sort of thing. So I think empirically speaking, it's impossible to know the best rebalancing frequency without knowing the actual future of like asset prices. But I think that if you rebalance more frequently, you are going to be less exposed to that kind of rebalance timing luck phenomenon. You're going to have if you think about all the different ways the future could play out, you will have a tighter distribution of outcomes the more frequently that you rebalance. Does that make sense?
Yep, totally. Awesome. I mean, okay, awesome. I think that's great. I just want to quickly recommend a book actually that I read a little while back that talks really explains the concept really well and sets up a few example portfolios you can use. It's called Millionaire Teacher. I don't know if you've read that one, by Andrew Hallam.
We actually have a review of Millionaire Teacher on our website. So yeah, I'm familiar with the book.
Perfect.
Awesome. Well, this has been absolutely fantastic, Nick. What if people want more information, where should they go to get it?
Yeah, so I would say the best place to learn about Passiv is just on our website. Our website is passiv.com, passiv.com. If you're a customer of Questrade, you can actually get the Passiv software for free through a partnership that we have with them. So any Questrade customers, come try it out. You'll never pay, you'll get at least the first year for free anyway. And if you have any questions about the software, or if you want a demo or anything like that, please just send me an email. My email is nick.mccullum@passiv.com.
Perfect. Awesome. And we'll include all these in the show notes as well. So just to make sure the spelling is all correct. Well, Nick, thank you for coming on the show, man. This has been great. Ton of info. I think I learned a lot. I don't know, but you, Brad?
Oh yeah, buddy. I mean, Nick, there's a couple of points there where you said I could talk for another couple of hours, and I'm thinking, oh my goodness, it's early in the morning. I don't know if I can handle that right now, but yeah, ton of information. And I think, like you say, our audience is largely real estate investment based, but it is really important to diversify. We talk about stocks, bonds, funds, ETFs, whole life policies, universal. There's so many options, but it is really important to diversify and just make sure you're well covered as you move towards retirement, really.
Mm-hmm.
Yeah. Well, thanks, Phil and Brad. This was a lot of fun, and hopefully someday in 6 months or a year, we can come back and do this again.
Oh, look forward to it, man.
Awesome. Thanks, Nick.
Yeah.
Thank you for listening to the Commonwealth Home Ownership Podcast. Be sure to check out all of our past episodes and our ever-growing library of content at cwho.ca. Until next time, remember to get out there, take action, and create a life of wealth by design.